Succeeding in a digital and non-face-to-face world. We are certainly living in interesting times, times of upheaval and times of stress. We're being told to practice physical distancing and isolation and to avoid or stop face-to-face interactions. And who says this business was so easy anyway when it comes to attracting and placing business? Never mind dealing with the pandemic and no physical face-to-face meetings. How can advisors meet client needs and keep their practices alive and well? My name is Peter Wouters. Welcome to this session on succeeding in a digital and non-face-to-face world. These times spur innovation and reveal how existing tools can help retain some sense of normalcy. This session reveals and reviews the evolving expectations of consumers in dealing with both finances and financial advisors. It's a new norm that's developed aside from restrictions placed on all of us regarding physical face-to-face business. Advisors will learn how they can respond and adapt to these expectations and the current environment, using tools that optimize technology and bridge social and business distancing, including the writing of new life and investment business. This is a two-part webinar. The second session, delivered by David Thomas, will provide a current summary of Canada's COVID-19 Emergency Economic Response Act and how advisors can help. Again, we have the standard disclaimers that this presentation reflects the views of Empire Life as of the date presented, and it is not designed to provide you with any type of legal, tax, financial, or professional advice. Insurance companies are starting to see spikes in submissions of life insurance applications. The pandemic has people thinking and worrying about their mortality and health issues, as well as those of family members. Law firms are also seeing increased interest in wills and powers of attorney. This from two studies that were released in late March. The first one, 10 Ways COVID-19 is Affecting the Life and Annuity Distribution World. And the second one, Are Wills an Essential Service? Will survivors have enough money to deal with expenses, loss of income, debts, and taxes? Will assets be protected? Will they go to intended beneficiaries? Life insurance is becoming more of a top-of-mind topic. Guarantees on investments are piquing the interest of investors. Insurers like Empire Life are seeing increased application count and increased electronic applications and throughput processes that can accept, process, issue, and send contracts to clients seamlessly, quickly, and dependably. Are you positioned to capitalize on all of this in your practices? During my session on why segregated funds, I shared some recent findings covered in a webinar in which I participated, Serving Complex Client Needs, and Julie Littlechild's Absolute Engagement in late March of 2020. The surveys noted that there has been a dramatic increase in the desire of investors to want to reach out to advisors. And this includes a rising number of investors who do not have an advisor. This industry is prepared should claims rise on the life and investment side. Many companies model and plan for the impact of potential pandemics and market turmoil, and then adjust their balance sheets accordingly. Regulations require companies to hold significant reserves to manage any claims volatility, and the impact is further mitigated by reinsurers backing up insurers' claims by taking on a portion of the risk. Clients need help. They need comfort and guidance. They're looking for leadership from advisors who can demonstrate they are responsible, responsive, and reliable. Digital solutions and processes can help position advisors to be a go-to resource. And the companies we represent are in the business of providing guarantees, so very valued when markets and the environment are in turmoil. This too can help clients be confident of the protection that we provide. Here are the four areas I will cover off today. 1, the benefits of digital. 2, target market segmentation. 3, digital and non-face-to-face processes for new business. And 4, digital strategies using fast and full. I'm going to begin today's presentation by talking about some of the benefits that advisors have realized by embracing digital technologies into their practices. These benefits have been realized years before the COVID-19 pandemic with its accompanying physical distancing imperatives. Going digital alone doesn't guarantee that you will be successful. However, I think you'll see that taking advantage of the digital tools available to you can be very beneficial to your business. It is undoubtedly a lifeline for advisors and clients working together to secure a new life and investment business during the trying times in which we are living and working in this physical, non-face-to-face world. So what is the most obvious benefit of going digital? Well, today, it allows you to stay in business when building your practices. It's an increase in number of clients, the amount of business that you do with you, and in assets under administration. After all, it's asset growth that allows you to grow and scale your business. A recent study by Fidelity found that advisors who use technology to drive revenue growth and serve more clients are outpacing their tech-indifferent peers in key metrics, including assets under administration. 97% use technology to provide value to their clients. 86% personalize their advice with technology. They are combining personalization with going digital, and it's working. These tech-savvy advisors, referred to as FlexGen, are growing assets under administration at twice the rate of their peers and seeing growth in numbers of clients 50% greater than their peers. We'll come back to FlexGen advisors later. A recent study from Broadridge supports the positive impact of technology, finding that advisors who adopt digital technologies improve their business performance in several key metrics, including productivity, revenue, assets under administration, and market share. And that trend is expected to accelerate going forward. Keep in mind that this study was completed in 2018, when no one anticipated a forced non-face-to-face world of doing business. These early adopters and those who quickly adapt will succeed in all weather conditions of the markets, all weather conditions of evolving customer expectations and competitive forces. One company has taken the lead on optimizing technology for advisors and the clients they serve. The benefits of embracing technology don't stop with just an increase in assets under administration. They help to build and strengthen the most important asset your business has, which are, of course, your relationships with your clients. This strikes close to home when we are confined at home during the COVID-19 pandemic and still want and need to conduct business. A recent study of investors found that technology usage is a key factor in client satisfaction, helping to drive greater transparency, collaboration, loyalty, and referrals. On that last point, the study found that clients are more likely to, one, recommend their advisor if they use technology to enhance the services that he or she provides. Two, recommend their advisor if they efficiently incorporate technology into his or her services. And three, recommend their advisor if they use technology to encourage client-advisor collaboration. So if your client relationships are your most important asset, going digital can help ensure you hang on to them and get more clients through them. And with integrated technology, including screen sharing, visual electronic meetings, and conferencing, you can not only survive, you can thrive in an electronic, digital, and non-face-to-face world, not just during regulated restrictions and prohibitions responding to COVID-19, but all of the time. So far, you've seen how going digital can help you in a number of tangible ways, including higher assets under administration. If those aren't enough to convince you of the benefits, then perhaps knowing that your competition is already taking advantage of technology will be reason enough to adapt, adopt, and optimize. We have advisors that only do business digitally. They moved to this position years ago as technology and tools became available. For them, it is pretty much business as usual in terms of new business for life, health, and investments when partnered with a company like Empire Life. From the Broadridge report, here are just a few examples of how your peers are using and getting real benefits from technology. 42% are boosting their revenue growth. 30% are using it to acquire, engage, and retain customers. And 27% are getting business in new markets and new client segments. Aside from adapting to restrictions placed on all of us to contain the pandemic, the question to ask yourself is simple. Can I really afford not to go digital if my peers increasingly are? And again, think about what happens when the extremely restrictive yet best practices of safety precautions ease up. Will you go back to paper processes? Will clients want to? And give up the efficiency and effectiveness of well-coordinated, comprehensive, end-to-end digital systems and processes. Finally, embracing technology and digital tools into your practice allows you to take advantage of client segmentation strategies that would otherwise be unavailable to you or would cost you a lot more in terms of money, time, and effort. A Fidelity study found that 54% of tech-savvy advisors, or e-advisors, are already implementing a client segmentation strategy into their practices. How many of you have probably heard a lot about client segmentation strategies over the past few years? And you may or may not already be using one or more in your practice. So my question to you is really a twofold question. How are you segmenting your existing clients? And how are you segmenting your future clients? On that note, let's shift focus a bit here and examine ways that you could implement a client segmentation or target market segmentation strategy in your business. Recently, LIMRA, the Life Insurance Marketing Research Association, which is the global life insurance industry's market research firm, did a survey of the target markets used by financial professionals. Now, when it comes time to target market segmentation, there isn't necessarily a right or wrong way to do it, but for the purposes of this presentation, I thought I would show you the most popular responses to the survey. As you can see, age, life stage, and wealth are the two most popular ways of doing target market segmentation, with profession or industry and a few others rounding out the list. Let's take a deeper look at these top two responses. When it comes time to age and life stage target markets, as you can see from the respondents, the most popular client segments to target are the pre-retirees, retiree, and combination of pre-retiree and retiree segments. This makes sense as these groups tend to have the highest amount of investable assets available. However, I want you to remember this slide, as we will be coming back to it a little bit later on in the presentation. Now, some of you may already have an idea of where I'm going with this. The second most popular method of target market client segmentation is to divide clients by wealth. Similar to the previous slide, we see that most advisors target the client segments with the most assets, the affluent, followed by the mass affluent. Again, this is primarily because these segments tend to have the most assets. And just like with the last slide, we'll come back to this slide later on in the presentation. Let's move on to fast and full digital and non-face-to-face process for new business. A number of carriers are moving to digital processes and are in various stages of going fully digital and offering non-face-to-face alternatives for advisors working with prospects and clients. Well, why listen to us, let alone partner with us on going digital, let alone conducting business on a non-face-to-face basis? For the second consecutive year and the third time in 4 years, we have been named Life and Health Insurer of the Year, in no small part for our commitment to constantly improve and innovate, especially for our fast and full online solution. I will be using Empower Life service offerings as a leading example of the tools, freedom, and flexibility available to you, and which can demonstrate your responses to quickly evolving customer demands and expectations. Let's consider fast and full investment applications. This was the industry's first 100% digital application for independent financial advisors for all segregated fund products. And that was almost 3 years ago for investments. It's been even longer than that for life insurance. Well, why the fast and full investment application? First, it's less administrative work for you and your team. T2033 transfer forms can be completed online and submitted by Empower Life. There are practically an elimination of not in good order follow-ups from customer service, and it eliminates sending any paper applications, forms, and checks via the courier. You can have your applications processed faster as well, including same-day trade dates before 4 p.m. for investments. And when your applications get processed faster, you get paid faster too. And it is fast. 44% of applications are issued within 3 business days. The median time to issue, 3 days versus 18 days for paper apps. Some applications can be issued in under 2 hours. And when you look at all of these statistics for life business, we also have electronic health questionnaires, e-signatures, e-contract delivery, instant approval, and electronic pay on approval or pay at issue processes and options available for advisors. Well, why the Fast and Full Life app? You can certainly serve more clients. It's great for non-face-to-face sales. It can expand your sales reach. Distance and scheduling are no longer restrictions. Of course, you need to be licensed where you are and where the client is located. You can spend more time selling and less time traveling and completing applications. It's available 24 hours a day, 7 days a week, and is certainly much more cost effective. When you can look at fast and full investment applications, again, I talked about some of the benefits earlier. We have DocuSign e-signatures, and we've had that for a number of years. This isn't just a temporary stopgap measure we're using. This is something that we have embedded into our processes. It's available for all Empire Life segregated funds and GIC products, including our guaranteed investment funds, our guaranteed withdrawal benefits, Class Plus 3.0, and guaranteed interest contracts. And it's available for all tax types. Registered plans, whether we're dealing with registered retirement savings plans, registered retirement income funds, tax-free savings accounts, locked-in plans like locked-in retirement accounts, locked-in funds, and of course is available for non-registered plans. And it's available for non-face-to-face sales. It is an efficient, advisor-friendly client management system that can save and recall applications in progress, that allows you to pre-complete client applications. Again, as I said earlier, it has an automated T2033 transfer process, or print and scan if a wet signature is required by the other organization. And it is designed for both mobile and iPad use. A key benefit that permits advisors to service your clients remotely and conveniently is our free co-browsing software solution integrated directly into Fast and Full, which enables non-face-to-face sales via seamlessly integrated screen sharing and video chat functionality. For clients and advisors who would otherwise have to travel long distances to attend face-to-face meetings, co-browsing, video chat can save time, reduce frustration with traffic, reduce carbon footprints, and in light of the often hazardous Canadian winter travel conditions, can actually help save lives. The process for non-face-to-face meetings and conducting new business is easy to use. On the preliminary page, check the non-face-to-face and confirmation boxes and click on the Start Co-browsing button. Then simply just share co-browsing link with your clients or invite clients via an email. Remember, Fast and Full doesn't replace your sales process. It makes it much more efficient. And that's great news for all advisors looking for efficiencies in their practices to boost the dollar return of the efforts that they actually expend. Now, there are more reasons to use Fast and Full. In response to feedback we actively seek out, we have made thousands of enhancements to our digital processes over the years and continue to do so, including Fast and Full apps for real-time status, new business in terms of real-time status, download forms, both your favorites and top forms. The drop-down menus allows you to customize your profile in terms of details with a link to updates. There are quick links there that provide shortcuts to useful tools and applications, and there's an opportunity to provide more feedback about what you like, what you think you'd like to have, and what is bothering you. The reasons don't stop there. My Client Dashboard helps you manage your clients. And again, this is part of our entire digital process. Up to now, I've talked to you about the benefits of going digital, showed you some common target market client segmentation strategies, and demonstrated the value of our Fast and Full application process. Now, I would like to spend some time showing you how you can use Fast and Full investments to implement some digital customer segmentation strategies into your practice. Let's start off with the first strategy, which is targeting underserved and undersaved clients. Remember those two slides I showed you earlier? I told you I was going to come back to them, so here they are again. If you recall, The common element in both slides is that most advisors were targeting the most affluent segments, depending on the strategy used. So while this makes sense, and everyone wants to catch the big whale, what I'm here to show you is that using Fast and Full, you can target client segments that are underserved and who undersave. As you can see, only 28% of advisors using an age and life stage segmentation strategy indicated they are targeting young and working year clients. And only 13% of those using a wealth-based strategy are going after middle market clients. So how can you take advantage of this? Well, first let's find out if these segments really are undersavers. This chart shows household contribution rates for the three major registered savings accounts for underserved and undersaved consumers. The same story plays out here when we look at registered retirement savings plans and tax-free savings account ownership rates by after-tax income. Remember, there's no income requirement for tax-free savings account contributions, and we shouldn't confuse after-tax reportable income with cash flow, repositioning assets, or opportunity for you as advisors. Again, you can see there is tremendous opportunity here for you to help the majority of Canadians in each of these income brackets on the road to saving for retirement. The key, of course, to making this worthwhile and productive for advisors is to leverage technology to minimize time and effort, particularly on new business paperwork. Now I know what you're thinking. The reason that rich retirement savings plans and tax-free savings account ownership rates are so low is because these Canadians don't want to be saving. And to be fair, for some of these Canadians, that's true. But as a counterpoint to that argument, let me present investor sentiments around saving for retirement from the HSBC's 2017 Future of Retirement Canada report. As you can see, 38% of millennials and 23% of Gen X respondents haven't started saving for retirement. But what is perhaps even more interesting is not the number of millennials and Gen Xers who have or haven't started saving for retirement, it's their attitude towards savings. Almost 7 out of 10 millennials and almost 6 out of 10 Gen Xers responded that they were prepared to cut their present expenses in order to save for retirement. 3 out of 4 millennials and almost 7 out of 10 Gen Xers acknowledged that while saving is difficult, it is necessary. And 57% of millennials and 64% of Gen Xers are worried that programs like social insurance, the Canada-Quebec pension plans, and old age pensions won't be enough to support them, a strong incentive to take personal responsibility and action. The question I want to ask you is this: what can you do to make it easier to begin saving for these clients? Your challenge as an advisor is to do a number of things, and it is to make it easier for your clients to begin saving. Your challenge as an advisor is very simple. How can you implement a digital customer segmentation strategy that allows you to target these underserved and undersaved Canadians to help them begin saving for retirement? The solution, of course, is to use the Fast and Full process to simplify the client onboarding experience to make it simple, fast, and easy for these clients to begin saving for their retirement. Let's take a quick look at 2 examples of case studies using Fast and Full investments. In the first one, we have Sarah and Stu, 34 and 33 years of age, respectively, self-employed, who want to start saving for retirement. They don't have a lot of time to meet, and they have an income of $85,000 before tax. What can you recommend for these clients in terms of an approach to securing them as clients? Use the Fast and Full investment application process. Offer guaranteed investment funds. Complete the investor profile questionnaire, which you can do electronically, and you can set up a one-time pre-authorized deposit. Let's consider Mike and Leanne, 55 and 49 years old, respectively. They've got 2 children in university. Each have defined benefit pension plans, and they're ready to ramp up retirement non-registered savings. They're looking to consolidate their assets and generate retirement income, and they have an income of $125,000 before tax. By using Fast and Full, you can set up a non-registered guaranteed withdrawal benefit plan, a plan that allows people to accumulate at the front end and derive a lifetime guaranteed income at the back end. And again, you can set up a one-time pre-authorized deposit. And if these monies are registered, you can use a T2033 form to handle transfers of registered assets. A related strategy is targeting not just where the wealth is today, but where it's going to be tomorrow. The great wealth transfer between generations is already underway. How can you take advantage of it? Many millennials and Gen Xers in Canada are inheriting assets from their parents over the next few years, with a total transfer of more than $1 trillion. Yes, it may only be $700 billion right now because of the market corrections, but it still is a lot of money, and the markets may drive up values down the road. Clients who have relatively low net worth today may be high or very high net worth clients tomorrow. And those same heirs may be managing the affairs of their incapacitated, wealthy parents. The time to start building that relationship with these two cohorts is now. How do we appeal to these potential clients? With millennials and Gen X as the principal beneficiaries of the new ongoing wealth transfer from boomer parents, the good news is that 48% of millennials and 55% of Gen X already prefer to buy financial products through an advisor with whom they have a relationship. Professional financial advice will be even more in demand as assets grow. And as I pointed out in the opening of the session, there is an increased interest by consumers to reach out to advisors, whether or not they already have a relationship with an advisor. The challenge for them now is how can they connect easily, comfortably, and confidently with an advisor? You certainly have the tools and processes available to you to make that productive connection. Millennials and Gen X also trust technology and are used to managing their finances online, with a significant majority saying that technology gives them peace of mind when it comes to finances. Millennials in particular prefer to work digitally. So how do we capture the needs of these groups who want both human advice and digital convenience? Again, the challenge is straightforward. A digital customer segmentation strategy that allows you to target these, the beneficiaries of wealth transfer. Again, use Fast and Full to provide the simple, fast, and convenient online experience that they expect. Reach out to us about these strategies and more. But here's an example of a case study for using Fast and Full investments to reach this market. Let's look at making unprofitable clients profitable. And in this strategy, I want to talk about today using a Fast and Full investment to turn clients that were previously unprofitable to you to do business and to conduct business and to build your business on a profitable basis. Again, your challenge in this environment is pretty straightforward. How do you make younger or more smaller account size clients a profitable part of your business? Well, again, the answer to use is Fast and Full non-face-to-face options to these service offerings and provide your clients with these services and products digitally and profitably. This next slide comes from everyone's favorite government agency, the Canada Revenue Agency. As they have a vested interest in tracking tax-free savings account balances, they produce some statistics on the sizes of these accounts. Here you can see the average account size by a number of different age bands, and also the average size across all Canadians. Looking at the cost of gas generally, aside from good prices when no one is traveling due to the pandemic, and the average account size, my question is, does it make sense to drive across town to sell a tax-free savings account? Here's a sample case study of how you can use Fast and Full investments non-face-to-face option to make a small dollar tax-free savings account client profitable to you. Meet Tanya, 19 years old and a full-time student. She has a part-time job making minimum wage. She's looking to invest a portion of her weekly paycheck, and she wants a quick and easy digital solution. By using the Fast and Full solution, particularly for investments in this particular case study, you can set up a non-face-to-face sale, offering one of our guaranteed investment funds, set up as a tax-free savings account, and again, set up a one-time pre-authorized deposit and weekly deductions. The third strategy I'm going to share with you today is using Fast and Full to expand your distribution of your sales territory. And by expand, I don't want you to think just about the next town over, think nationally. The challenge for you is, how can you keep and expand your client base regardless of wherever you and your clients live? Again, use the Fast and Full non-face-to-face option anywhere you are licensed or can be licensed to sell insurance and insurance-based investments. Again, let's take a look at a few case studies of how you can use Fast and Full to gain new clients and keep existing ones. Meet the Bakers. They have an only daughter who's 36 years of age. These are VIP clients for you who have over $1 million in assets under administration. The baker's child lives across the country with her husband and young family. Your client wants you to manage their savings, and they have an income of $115,000 pre-tax. The solution? Get licensed in that province. Use the Fast and Full investment process on a non-face-to-face process. You can set up registered retirement savings plans and effect an automated T2033 transfer. Meet Kate and Melissa, 41 and 38 years old respectively, who recently moved across the province. They value your service and advice, and they want to transfer their defined contribution pension plan assets from their previous employer and have you manage that. By using the Fast and Full solution and Fast and Full investment process and application, you can do this on a non-face-to-face process, and you can use an automated T2033 to move those assets to Empire Life. Let's take a look at a typical day close to the end of RRSP season, or Registered Retirement Savings Plan season, February 27th. An example that comes from a January webinar that you can access on the Empire Life website. Now, of course, I'm using Registered Retirement Savings Plan, but as you're finding these days anyway, tax-free savings account are as popular, perhaps even more popular than Registered Retirement Savings Plans. In any event, let's say for the sake of argument, you're willing to put in a 9-hour day and that you are spending about an hour meeting with each client. And that meeting includes making small talk, discussing needs, completing the application, collecting the check, packaging everything up, and saying your goodbyes. And let's say on average, you spend about 30 minutes travel time to and from each client. That means in a 9-hour day, you're able to see about 6 clients. And assuming the new RRSP, or Registered Retirement Savings Plan account, is set up with an average of $10,000, that is about $60,000 in new assets under administration. And assuming a low deposit commission structure, that would equal about $1,500 in commissions earned. Now let's see how much more efficient you could be with Fast and Full investments using the non-face-to-face option. Let's assume that because of the efficiencies of the digital sales process, you can cut that client meeting down to 30 minutes. And because it's a non-face-to-face basis, you've eliminated travel time. And let's say because you aren't spending all day driving around town, you only need to work 8 hours. With Fast and Full investments, you can see 16 clients instead of 6 and increase your assets under administration by $100,000 over doing the face-to-face meetings. And because this greater assets under administration, you're going to make 2.5 times the commissions, $4,000 compared to $1,500. The question I have for you is this: would you rather drive all over town for $1,500 or work from your office and make $4,000? To tie it all together, remember the FlexGen advisors we talked about earlier? These FlexGen operators capitalize on the opportunities that you've seen on this particular screen. Advisors are seeing the most successes are the ones who are meeting the needs of the underserved markets and the undersaved markets, who are using technology to future-proof client relationships and are providing a client experience that is both interactive and collaborative. Again, according to the Fidelity study, these are the key elements to their success. And before I finish, I do want to remind you that you'll receive a $50 bonus for the first Fast and Full investment application you submit. So try it out today. There's also a 50% Fast and Full Life e-bundle bonus that you can earn until July 30th of 2020. Again, you can earn up to 15% more first-year commissions when you submit life and health applications electronically using the Fast and Full Life application. Now remember, the Fast and Full Life application is fast. 41% of applications are issued within 3 business days. The median time to issue, 3 days instead of 18 days for paper applications. Some applications can be issued in under 2 hours. We have an electronic health questionnaire, e-signature, electronic contract delivery, instant approval, and electronic pay on approval or paid issue options. To review this session, here are the 4 areas I covered off today: the benefits of digital, target market segmentation, the Fast and Full process for new business, and Fast and Full strategies. I encourage you to visit our fastandfull.ca. Log in with your Business Center ID and password or learn more at empire.ca. Earn more. Now, if you don't want to do it that way, please contact your Empire Life sales team. These are the members of the national sales team on the investment side, and these are the national sales team members on the insurance side. For those of you that are interested in it, you can always ask for a hard copy handout of this particular presentation to get the contact numbers and names, as well as the faces of all those people here to help you out. We are indeed living in interesting times, times of people and times of stress. We're being told to practice physical distancing and isolation and avoid or stop face-to-face interactions. And who says, again, as I said at the beginning, that this business is so easy anyway when it comes to attracting and placing business, never mind dealing with the pandemic and no physical face-to-face meetings. I hope I answered the question about how you as advisors can meet client needs and keep their practices, your practices, alive and well, not just now, but in a changed future. This session has hopefully shown you how innovation and existing tools can help retain some sense of normalcy and allow you to ride the waves of change. I've reviewed the evolving expectations of consumers in dealing with finances and financial advisors as a new norm. It's a new norm that's developed aside from restrictions placed on all of us regarding physical face-to-face business. Hopefully, you have learned how you can respond and adapt to these expectations, the current environment, and a changed future, using tools that optimize technology and bridge social and business distancing rules, including new life and health investment business. Look to us to be a strategic partner with you today and for the tomorrows to come. I will now pass you on to the next session, which will provide you with a current summary of Canada's COVID-19 Emergency Response Act and how advisors can help.
Hello, and welcome to the second part of our two-part webinar today. My name is David Thomas, and I'm the Director of Tax and Estate Planning on the life insurance side of our business at Empire Life. In this presentation, I'll be providing an overview of Canada's fiscal plan in response to the COVID-19 pandemic. These are indeed difficult and strange times for all of us. Even these guys are wondering what's going on with the humans. The outbreak of COVID-19 is having a significant impact on all Canadians. According to a March 25th news release by the Department of Finance, the Government of Canada is taking strong, immediate, and effective action to protect Canadians and the economy from the impacts of the global COVID-19 pandemic. No Canadian should have to choose between protecting their health, putting food on the table, paying for their medication, or caring for a family member. What's available from a monetary perspective to provide relief to Canadians. This session will highlight the various federal monetary policies that provide income support for Canadians as part of Canada's COVID-19 fiscal plan. And advisors will also learn about how they can get involved in supporting clients and business owners who need to help and direction accessing these programs during the pandemic. Often we cover or pass by our disclaimers rather quickly, but today there's another aspect to this that I need to make note of. The fiscal measures announced by our government are coming out quickly and often on what seems like a daily basis. And while we have made every effort to keep the information contained in this presentation up to date, it has been prepared in advance for such things as review and translation and is recorded prior to the date that it is aired. So there may have been recent additional announcements not included in this presentation. However, this material should be current up to April 27th, 2020. Here are the 5 areas that I will cover today. An overview of Canada's COVID-19 fiscal plan, the Canada Emergency Response Benefit, the Canada Emergency Business Account, the coordinated support role for advisors, and addressing concerns for consumers. First, an overview of Canada's fiscal plan. The U.S. Federal Coronavirus Aid, Relief, and Economic Security Act, CARES program, a stimulus bill, was signed into law on March 27, 2020. In Canada, Bill C-13, the COVID-19 Emergency Response Act, was introduced in the House of Commons here in Canada on March 24th, 2020, and received royal assent on March 25th. Here's a breakdown of what's included, along with other programs being rolled out to support working Canadians and businesses. The March packages provided a $107 billion stimulus package in Canada, a $2 trillion economic aid package in the US. Both were signed into law in late March, and both have undergone a series of changes and enhancements since that time. You have heard some terms thrown around dealing with stimulus packages. You or your clients may not have an easy way of explaining what they do. Let's divide this into two areas. The first is monetary policy, providing quantitative easing, often referred to as QE. The intent is to make it easier for businesses to borrow money by lowering interest rates. Lower interest rates are intended to make stocks more attractive to investors, particularly foreign investors. The central bank buys bank assets to pump money into the financial system, increasing money supply for individuals and businesses. This new money is generally used to buy financial assets other than government bonds. Essentially, it's an asset swap, so no increase in buying power or net worth in the private sector results. The second area is fiscal spending or deficit spending by the government. The government spends more money than what it brings in, creating a budget deficit. The government borrows money via treasuries or similar instruments. The money funds initiative for the government and business. It is sometimes intended to increase or preserve private sector assets. Governments at pretty much all levels have been extending deadlines for payment of taxes or other government levies. Here's what the federal government has done. Individuals have until June 1st, 2020 to file their 2019 income tax returns. Individuals and businesses have until September 1st, 2020 to pay any balance owing on their 2019 returns. Self-employed individuals still have a tax filing deadline of June the 15th, 2020, and trusts that report annually will have until May 1st, 2020. The deferral so far does not apply to HST or GST remittances. In recognition that financial assets have become hard hit, the government has reduced the Registered Retirement Income Fund minimum withdrawal requirements to help retirees avoid the forced sale of assets at reduced prices. Effective on March the 18th, the minimum withdrawals for a RIF are to be reduced by 25% for the remainder of 2020. Similar rules will apply to workers receiving benefits under defined contribution pension plans. The adjusted minimum does not apply to the income tax provisions relating to the amount included in income in respect of a spousal registered retirement income fund or for withholding tax rules. The RIF minimum amount can continue to be paid at the pre-March 18th level without withholding tax on the amount in excess of the new minimum. And further details are still being worked out. There have also been changes made to the child care benefit packages. The maximum under the child care benefit is to be increased by an extra $300 per child for the 2019-20 benefit year, with the additional amount to be included starting in the May benefit payment. The first temporary wage subsidy was announced with an entitlement to a wage subsidy of 3 months equal to 10% of the remuneration paid during the period. There was a maximum of $1,375 per employee and $25,000 per employer, and it applied to wages paid from March 18th to June 20th, 2020. The eligibility for that program included corporations that could claim the small business deduction. They must have a payroll account with Canada Revenue Agency as of March 18, 2020. They must have less than $15 million in taxable capital employed in Canada in 2019. The program was aimed at employers experience a 30% or more drop in revenues, adjusted to a 15% drop for March, and employers could choose either January or February for comparison purposes. Any employee, including family members, were eligible. Also, nonprofits and registered charities are eligible. There may be potential enhancements to this program, and in fact, there were subsequent announcements to this part. Employers need not apply for this wage subsidy. They would have to manually calculate the subsidy when submitting their payroll deductions. The Canada Revenue Agency would then use these submissions to pay the wage subsidy to employers, and dividend income was ineligible. There were revisions made to this program in March, late March 27th and 28th. The result was, in effect, that employers may be eligible for a subsidy of up to 100% of the first 75% of the pre-crisis wages or salaries of existing employees. These employers would be expected, where possible, to maintain existing employees' pre-crisis employment earnings. Eligible remuneration may include salary, wages, and other remuneration. Dividend income was still not included. Tough news for business owners or operators who choose to pay themselves dividends rather than salaries. Sole proprietorships and partnerships were not eligible. Employers will also be eligible for a subsidy of up to 75% of salaries and wages paid to new employees. The 10% wage subsidy still exists to reduce payroll deductions to the Canada Revenue Agency. And here's how they will integrate. For employers that are eligible for both Canada Emergency Wage Subsidy and the 10% wage subsidy for a period, any benefit from the 10% wage subsidy for remuneration paid in a specific period would generally reduce the amount available to be claimed under the Canada Emergency Wage Subsidy in that same period. There are still lots of questions and gaps, inevitable when getting these plans implemented quickly, meaning details get missed. A joint paper was prepared on April 6th by the Canadian Tax Foundation and the Chartered Professional Accountants Association of Canada, documenting many of these, and answers are trickling in. The legislation for the $73 billion program of wage subsidy package was passed on the rare Saturday House of Commons session on April the 11th. It provided that employers must reapply and requalify monthly. All types of corporations are eligible, including foreign-controlled Canadian subsidiaries. There are exceptions for non-taxable and public sector corporations, for example, public schools, hospitals, and municipalities. That said, a joint federal, provincial, and territorial initiative aimed to top up the salaries of low-income essential workers who earn less than $2,500 per month on a full-time basis. As well, the Canada Revenue Agency is launching a new online calculator that will help businesses determine amounts that they can expect to claim through the federal wage subsidy program. There are exceptions to what's covered and penalties for abuse. For example, under the rules, an employer receives a subsidy of 75% of the current gross weekly pay of an arm's length worker, assuming that employer qualifies on other criteria, including suffering a loss of business after March 15th. If an arm's length employee got a raise, worked longer hours, or otherwise earned more during the coronavirus crisis than they did between January 1st and March 15th, the subsidies paid to the employer rise commensurately. However, if the employee is not arm's length, then different rules apply. For non-arm's length employees, think of the owner-managers and their family, then subsidies are based on the lower of current weekly gross pay and the average weekly gross pay between January 1st and March 15th. That means the subsidies will not apply to any increase in compensation. There has also been an emergency care and support benefits program announced. Workers who cannot work due to COVID-19 and are not eligible for employment insurance. Unemployed workers may qualify for up to $900 biweekly for up to 15 weeks. There will also be an emergency support benefit for workers who don't qualify for employment insurance and become unemployed. The government plans to implement work-sharing programs, which will provide benefits for workers who agree to reduce normal working hours. The next program implemented is the Canada Emergency Response Benefit, with its inevitable initials or acronym CERB or CERB. The Canada Emergency Response Benefit combines a $10 billion emergency care benefit with a $5 billion emergency support benefit announced mid-March 2020. It is available for any Canadian who has stopped working for 14 days due to the COVID-19 crisis for the first claim and earned more than $1,000 during that time. When submitting subsequent claims, applicants cannot have earned more than $1,000 of employment or self-employment income for the entire 4-week benefit period of the new claim. It provides $2,000 per 4-week period for the next 16 weeks and is taxable. It is available from March the 15th to October 3rd, 2020. The government has created a portal for accessing this benefit, which opened on April 6th, 2020. The government is targeting the receipt of the benefit in 5 business days if it is by direct deposit and 10 business days if it is by check. And of course, Finance Minister Morneau wants to shorten this period for the direct deposits. The benefit will be payable every 4 weeks. Eligibility for this Canada Emergency Response Benefit will be for workers who lose income due to COVID-19, including unemployed Canadians who don't qualify for employment insurance, full-time, part-time, contract, self-employed, and seasonal workers. Unemployed workers not receiving income due to disruptions in their work situation because of COVID-19. Also, if they're quarantined or caring for sick family or taking care of their children. Workers may still earn up to $1,000 while collecting the benefit. They must have earned $5,000 in employment income in 2019 or in the 12 months prior to the date of their application, and they would not have quit their job voluntarily. What counts as income? Employed or self-employed earnings like TRIIPPS declared as income, non-eligible dividends, honoraria including nominal amounts paid to emergency service volunteers, and royalties paid to artists like musicians and writers. There has been a website set up for further details at www.canada.ca/coronavirus.cerb. Sorry, that's -CERB. As announced by the federal government, Canadians who are already receiving employment insurance, regular sickness benefits as of today would continue to receive their benefits and should not apply to the Canada Emergency Response Benefit. If their employment insurance benefits end before October 3rd, they could reapply for the Canada Emergency Response Benefit once their employment insurance benefits cease, if they're unable to return to work due to COVID-19. Canadians who have already applied for employment insurance and whose application has not yet been processed would not need to reapply. Again, this program was not initially intended to cover public sector, hospitals, schools, municipal or local governments. But that said, discussions are underway to supplement the pay of essential staff. Think of nursing homes and long-term care facilities. Here again, an April 15th announcement shared that the federal government would work with provinces and territories to temporarily top up wages of essential workers who earn less than $2,500 per month. Details are still to follow on that. The move to Canada Emergency Response Benefits is automatic for the 2.1 million employment insurance applicants for applications made since March 15th, 2020. It applies to benefits received for the first full week in April. All will receive $500 per week. That means some will get more and some will get less than previously. Canadians who are eligible for employment insurance, regular or sickness benefits, will still be able to access their normal employment insurance benefits, higher or lower versus the Canada Emergency Response Benefit, if they are still unemployed after the 16-week period covered by the Canadian or the Canada Emergency Response Benefit. Employment insurance weeks are suspended while receiving Canada Emergency Response benefits. It is estimated that some 8 million working Canadians have applied and expect to receive benefits, according to the most recent StatsCan and Service Canada figures. One more plan and acronym announced was the Canada Emergency Business Account, or CEBA. The COVID-19 pandemic has resulted in only 20% of Canadian businesses remaining fully open. 30% of them have insufficient cash to pay April's bills, and 2/3 of them have rent to pay. So this program provides up to $40,000 in interest-free loans, 25% of which can be forgivable up to $10,000, and was originally available for businesses with payrolls from $50,000 to $1 million. The revised program expands the availability for businesses having a payroll from $20,000 to $1.5 million. While this will allow thousands of additional small companies to access this program, startups, the self-employed, and those paying dividend income continue to be ineligible. While some will say that the $40,000 cap on interest-free loans is low, it can be quite attractive to many small businesses that employ 1 to 4 people, at least for a reasonably short period of time. That said, it's estimated that 1/5 of businesses won't be eligible for these benefits because they operate as sole proprietorships, their payrolls are too small, and or business owners paying themselves dividends rather than salary. There are more than 1 million small businesses in Canada that collectively employ approximately $8.3 million, according to Stats Canada. We have another benefit program that was recently announced, the Canada Emergency Rent Assistance Program. Although we're at the early stages here, here's a brief overview of this program. 80% of small businesses are partially or completely shut down to battle COVID-19 spread in response to provincial orders. Commercial rent is the second biggest expense for most small businesses. 90% of small business owners want assistance, according to the recent research from the Canadian Federation of Independent Business. Only Saskatchewan and Nova Scotia offered rent support of any kind so far. The Canada Emergency Rent Assistance Program, announced on April the 16th, is the first Canada-wide rent support program for small business. The focus is to reduce and eliminate, not just defer, commercial rent costs. How will that work? This joint federal and provincial program is intended to provide loans, including forgivable loans, to commercial property owners who in turn will lower or forgo the rent of their small business tenants for the months of April on a retroactive basis, May and June of 2020. The Rent Assistance Program will work as follows. The governments will provide forgivable loans to qualifying commercial property owners. Property owners must agree to a written 75% rent deduction for eligible tenants and a pledge not to evict tenants during the agreement. Property owners get 50% of 3-month rent payments payable by eligible small business tenants for the April to June period, and the tenant pays 25% of the rent. Eligible small business tenants include those paying less than $50,000 per month and have temporarily ceased operations or have experienced a 70% drop in pre-COVID-19 revenues. The program will be administered and delivered by the Federal Canada Mortgage and Housing Corporation. As you are finding out, There's a variety of programs available for Canadian workers and businesses, replete with initialisms and acronyms and all that alphabet soup of language that simply confuses people and makes them feel ignorant. Details are oftentimes missing, with the need for governments to show they are responding quickly to the pandemic with support programs. Revisions and new programs are being contemplated and released regularly. It's understandable that people are confused. What are the industry associations doing to help out, and how can you be part of this? The Advocates Connect program is built on our association's credo, not for ourselves alone. And there's no better time than right now to step up and demonstrate the incredible value that we can bring to our communities. This is a national program responding to innovative solutions to assist small business owners with financial advice, namely to navigate relief programs and help them with their applications, provide guidance that will help them through the pandemic, and to better understand their balance sheets. Small business owners who do not currently have a financial advisor will be invited to register on a dedicated Advocates Connect website. After registering, Advocates will match the small business owner to a participating advisor within their area. Those who register on the website should be treated as a client during the COVID-19 crisis, with an Advocates member providing pro bono services by phone, email, or video conferencing. We recognize that your current clients must come first, and they only ask that you give what you can in terms of time. The financial advisor will ensure the client does not feel any obligation to continue their services after the COVID-19 crisis. The association has prepared an Advocates Connect scope of services document that we encourage all participating advisors to use with their Advocates Connect clients in order to better manage expectations. In addition, KLU has joined the Canadian Business Resilience Network. The network was established by the Canadian Chamber of Commerce and the federal government to help businesses prepare, preserve, and prosper. It is made up of 100 business and industry associations. Joining this network provides support for KLU and their clients during the COVID-19 crisis in the following two ways: tools and supports from business development to implementation, and to instill confidence in the Canadian business and the economy. One of the first initiatives is to coordinate a national survey of the business community, aimed to gain real-time insights into the needs and challenges, provide a consistent, reliable flow of accurate and current information, and inform the federal government's next steps. I invite you to connect with Peter Wouters on social media like LinkedIn to get a copy of this infographic. It's only available in English at the present time, but we can certainly get you a PDF summary of these slides in addition for your reference. Concerns about mortality and planning are increasing, as was mentioned in the earlier portion of today's session. That creates opportunities for professionals who deal with these concerns. How can Canadians comply with witnessing requirements for wills and powers of attorney? Remember, with limited exceptions, that for a hand non-written will to be valid, it must have two witnesses physically present to see the testator sign the document. Witnessing restrictions further dictate that any gift in a will to a witness is presumptively void. How can you address this when, in most households, physical isolation due to COVID-19 means people are sheltering in place by themselves or with only one other adult? The Ontario government has now addressed this problem using a regulation under the Emergency Management Civil Protection. Quebec has enacted similar provisions. Other provinces may follow these leads. Wills and powers of attorney can now be witnessed in Ontario remotely during the current emergency pursuant to this interim regulation. The following conditions must be followed to comply with the regulation. The technology used must permit participants to see, hear, and speak with each other in real time. Consider applications such as FaceTime, Zoom, Google Hangouts, Snapchat, or other enabling programs. A lawyer or paralegal must be one of the witnesses. In Quebec, a notary may now sign documents remotely. Willful is an online provider that offers a list of tips and physical signing, including safe distancing and sanitizing procedures. When it comes to the financial advisory business, Empire Life has been recognized as having the most responsive and leading edge and comprehensive end-to-end digital non-face-to-face process and toolkit to handle new life, health, and investment business. Speak with our account executive teams about Fast and Full. As mentioned at the beginning of this presentation, the outbreak of COVID-19 is having a significant impact on all Canadians. According to that March 25th news release, the Government of Canada is taking strong, immediate, and effective action to protect Canadians and the economy from the impacts of global COVID-19 pandemic. It may not be enough. This predicament is not reserved for people dealing with the fallout from the pandemic. It's felt by too many people who don't have the money or liquidity to maintain some sense of normalcy when tragedy strikes due to death, disability, or inadequate access to cash and low retirement savings. These predicaments are the ones that financial advisors are called to address, working with Canadians to put in place solutions that provide liquid dollars when they are needed most. And we at Empire Life offer a broad array of tools, solutions, and processes to help you with them. So now, as our friend says, you understand why it's so hard to sit in place.